Well, as we await U.S. inflation data at 8:30 a.m. Eastern Time, our next guest says we need a Goldilocks scenario to ward off recession fears. Our featured guest, of course, is Allan Small, Senior Investment Advisor for IA Private Wealth. You made a good point in a conversation we had just before we went to air, Allan, that what the market, I think, really wants to see is some downward movement in core inflation. That's the measure that the Fed watches most clearly. And if economists are correct, that number is going to prove stubborn. It's going to remain stuck at 4.1% if economists are correct in their forecasts.
Yeah, and I think it's the services side of things. That's been the stubborn part of inflation since the beginning. And you kind of wonder, right, the headline number falling, is that just all oil falling, right? We've seen the price of oil come down really since the fall, beginning of the fall, September timeframe. We've seen oil now in below $80 a barrel. Is inflation, the headline number, falling just mainly because of oil, or are we seeing other things behind it? So I think that's what we're all going to be focused on, because that's what the Fed is focused on when it strips out the volatile energy prices. Where's inflation? And I think we're going to see that it's still above 4%.
So we don't want to see economy running too hot. We also don't want a recession. What does that look like in terms of economic data?
Yeah, exactly. And so, it's not too hot, not too cold, just right kind of scenario. If we get a number that is starting to see things starting to fall too much, then everyone will start to worry about that recession that a lot of people are predicting sometime in 2024. If we're seeing numbers that are too hot, then we have an inflation problem. So unfortunately for the Fed, they got to walk this really tightrope here, right down the middle, and not too hot, not too cold, just right. With good news sometimes is looked upon as bad news looked upon as good news, but you don't want too much bad news. It's this juggling act that we've been experiencing really for the last year and a half, and I don't think that's going to end anytime soon.
You're critical of the signals that Fed speakers have been sending to the market.
Yeah, very critical. I think the Fed governors are maybe speaking too much. We always want transparency. But you have, I think, somewhere in the vicinity of, 10 different Fed governors speaking over the next few days. I think Austin Goolsbee will speak today, Chicago Fed. And, they're telling us all their opinions. And one opinion clashes with another. One's hawkish, one's more dovish. And the market's just moving up and down, going all over the place. I think the Fed is more reactionary than proactive. They're reacting to numbers that they're looking at in the rearview mirror versus where are we going to be in 3 to 6 months from now. I know Mohamed Al-Arian, recently said that he felt the Fed was way too reactive. They need to get ahead of things versus react to the news. And I agree with that. And I think, you want to know where the ball's going, not where the ball has been. What does Wayne Gretzky say? Move to where the puck's going, not to where the puck has been. So for me, I think that has caused a lot of volatility. It's caused a lot of volatility in the bond market. We're seeing bond yields moving just unbelievably, like the stock market, and that shouldn't be the case. So for me, the volatility, I think, is a lot of it is being caused by what the Fed governors are actually saying. And I think maybe if they kept quiet a little bit more, I think the volatility would be a little less.
Do you think, as we look at U.S. bond yields down today, so bond prices are rising somewhat as yields come down, very quickly, do you think the Fed has finished raising rates?
I do. I do think they're just going to talk down rates perhaps even more, but I think overall they are done raising rates.